Everybody, this is your host, 𝘽𝘀𝘾 with the Freedom Report, and this is going to be the weekly market report for May 7th, 2024. It's Tuesday. Welcome, everybody, to the report. We're going to cover ground for the last couple of weeks, since I didn't do one last week, and I have a special announcement about the channel coming up at the end that we've already sort of hinted at over social media, but we're going to jump right into the market report and tell you what's been going on. At the beginning of the month, we had a lot of impactful economic data, starting off with the employment cost index and wage information. Wage information is up. U.S. hourly wages are up 0.2%, and employment cost index has risen 1.2%. So we're seeing wage inflation in the cost of hiring employees, although it's not keeping up with inflation. So their salaries and wages aren't rising as fast as inflation is for prices in the economy. We're still seeing where wages are going up. And I think as a result of that, plus some of the structural issues we have in the economy, employment overall was down. ADP came out with an employment print on the May 1st of 192,000. That was less than the previous month of 208,000. So that was definitely down. Initial jobless claims were up to 208,000, which means there were 208,000 people who couldn't find jobs that were looking for jobs. And those are new people filing jobless claims. And I think a lot of that is a result of some of the layoffs we've seen in the first quarter of the year. The U.S. employment report, or previously called the non-farm payrolls report, had adding jobs of only 175,000, which is down substantially from last month's print of 315,000. So certainly looking at the increase in wage rates and the increase in initial jobless claims, along with the fact that the jobs actually being created in both the ADP and the government U.S. employment report are down and under expectations, is a signal that the labor part of the economy is starting to cool off. There aren't as many jobs available, and it's been a little bit harder for people to find work. The unemployment rate, as a result, rose from 3.8% to 3.9%. And the hourly wages year over year, the increase in wages from last year to this year is up almost 4%, it's 3.9. So we're seeing a heavy bounce of inflation and employment costs, which I think is causing employers, given the shrinking overall spend in the economy, it's a warning sign that employers are not hiring as many, that it looks like we may be on a downswing in the economy. Now, we'll see if this leads to an official recession call. So far, we've had positive GDP prints. So it may just be that we're before the official recession call by a quarter or two. I don't know whether we'll get that this year. We can certainly talk about that. Being an election year, they may not want it to officially announce it. We'll see what happens. So far this week, there hasn't been a lot of information released that's actual usable. We do have consumer credit wholesale inventories, initial jobless claims for this week, consumer sentiment, and all those types of things coming out soon. So we'll follow that economic data on the next report. Wanted to go over the markets. The last couple of months, the market's basically been trading down. The NASDAQ is the only thing that's almost reached its 60-day mark from where it was 60 days ago. It's fallen a little bit, but overall, it's better than most of the markets. If we look at the Dow Jones, it is down right now, trading at 38,908.45. 60 days ago, we had it trading at 39,807. So it's down about 900 points in the last couple of months. Same thing with the S&P 500, it's down as well. We also see stress in the bond market in terms of increased interest rates. The 2-year benchmark has traded up to 4.803. Now it's down 19 basis points today, but it's up to 4.803. And that trend has been up over, the last, dating back to the beginning of the year. It's risen. Beginning of the year, it started at about 4.38%. So it's gone up about 0.5% in the first quarter of this year, a little bit more than the first quarter of this year. The 10-year rate is at 4.429. And that has increased as well since the beginning of the year. It was trading at just under 4 at 3.944. So it's gone up about 0.5% as well. So we're still in yield curve inversion, which means that shorter term debt requires higher interest rates to get people to buy, which is a signal that the economy is not doing as well in the short term. People think that there's a recession coming. That's the biggest consistent recession indicator, is the 2- and 10-year yield curve inversion, where it costs more to get the 2-year than the 10-year, but both markets are up. So there's stress in the market. The bond market is demanding higher rates because of the risk in the system. And it looks like employment is starting to falter a little bit as wage cost growth is rising and available jobs are falling. and initial jobless claims seem to be rising as well and very strong. So that's your economic report. I promised that on this weekly market wrap, we would do an examination of the precious metals market. So today I'm going to focus on gold, and I'm going to look at some charting. We're going to look at the COT report, and we're going to look at margin requirements and why we may have a cooling off in the gold market. And then next week, I'm going to focus on silver. So we're going to focus on gold today and silver next week. So we'll go ahead and jump into the charting for gold. This is a longer term chart I did on TradingView, and I'm basically just graphing out the long-term trends. You can see dating back to 1975, drawing a line through the upper part of the gold market, the increasing highs that were basically on trend with what has basically occurred in 1979. That was the big inflation that we had back then in 79 and 80, where if you remember, the Fed had to significantly increase interest rates about 18 to 19% to cool off inflation in the economy, make the cost of borrowing so high that it reduced the amount of dollars in the system. Then from 2008, 2011, we see a big increase, a big rise from, oh my goodness, at 2008, we had about $600 gold, went all the way up to almost 1900, as you can see on the chart. So a big increase in gold price during the last recession. Of course, we've had that cup and handle pattern form since the previous all-time high of 1900 in 2011 through to the 2020, 2021 timeframe. And then since then, we've basically been trading within the established channel for gold. So this is why I would say that gold itself is not in a major breakout in terms of it's not breaking out of a trading range, because you can see dating back to 1975, it's pretty much in the expected trading range in terms of the highs and where the highs are hitting. And you see at the chart, I've got this big orange circle around 23, 22, 59. Gold got about $2,400, which was the top of that long-term trading range back to 1975, and the continuation of that trading range from the last previous high, 2011, to now. So over a 13-year time frame, it stayed basically within that range of higher highs in the overall trend, which is why I say it hasn't broken out into a bubble just yet. Gold's definitely not in a bubble. It's basically trading within that established range, and it's basically a trading within the CPI-produced inflation numbers. I don't believe it's trading to the real inflation numbers, and so gold has a lot of room to run before it's equally valued to where it was in the 70s and early 80s from a real inflation perspective, but certainly from a government-published CPI inflation perspective, gold's basically following the trend. As you can see, I've graphed out some Fibonacci's. That's the colored bars on the right-hand side of this chart, and what that does is Fibonacci's are specific mathematical numbers that seem to repeat in nature. They, of course, follow markets as well. And if you look at those Fibonacci numbers, that gives you trading ranges where traders may trade back to or trade forward to in terms of what it's been. So I graphed it out from basically the low on the chart in the 1970s and 1980s up to the current time frame, and did the Fibonacci sequence. And if you can see, one Fibonacci level back would be about 1,833 gold. So if we're going to have a gold pullback, I would think if it retraced to the bottom of this trend channel dating back from 2003 to now on the lows, if you look at that bottom green line, certainly it could trade back to about 1,833 and still be within that long-term trading range. Personally, I don't think it's going to. I think there's too much going on in the economy that it's going to hit the bottom side of this cycle. And indeed, it hasn't really tested it since 2019. Ever since the shutdowns in the economy and the health crisis that we had, essentially you can see gold trading up into the middle of this long-term trading range dating back to the beginning of the century, 2000, 2003. And then testing highs in this channel. It tested highs in 2011 during the financial crisis, and it's testing highs again now. Mostly it's testing highs again now because of what happened to the banking system about a year ago, and it's been trading up. Since then, of course, we saw the reports of the economy, the U.S. economy, in terms of lack of overall job creation, issues with debt, continued fears about the banking system, the lack of consistent earnings reports across corporate America. So we saw gold spike up to about the $2,400 range. It's retesting that channel high, but it hasn't punched through. So I don't think we've had the big breakout in gold just yet. I think it's testing channel highs dating back to not only 2000, but also the 1970s, which is very clear. And it's clear to me, I don't think it's going to trade back at the bottom of this channel. I don't think it's going back under 2000 anytime soon. I don't think it's going to land in the 1833 mark. But I just wanted to put those there as a reference point for you guys to see essentially what we're looking at from a long-term perspective. Now let's zoom into a shorter term perspective. This is basically like a 6-month or so chart. And you can see this Fibonacci sequence, the line between the gray and the blue part of the screen is that Fibonacci level. And that dotted line is the retracement. If you look at the Fibonacci's, what it could retrace down to if gold is pulling back. Now in April, certainly it broke through that key Fibonacci line. That's the first green arrow on the chart. And it traded all the way up above 2,400. It tested that 2,400 level twice and then came back down. And after it tested it twice, it fell back through that Fibonacci back to the downside. That's the first red arrow that we see here. And that is psychologically important because traders will trade to different trade levels, and Fibonacci is a very famous way to measure what the next pullback or what the next forward or higher price could be in any market. And you can see that we've retested that Fibonacci line at 2322 now twice. The first green or the middle green arrow on the chart and the third green arrow on the chart, we've tested it actually 3 times. We tested it and broke through in late April. We tested it again at the beginning of May, and again basically yesterday we're testing that 2322, 2325 mark. And what you're seeing here is the market consolidating. This is a consolidation pattern lately where we had the big blow up into $2,400 gold. It didn't hold. There was a tracement or a pullback to around that Fibonacci line, that important trading line, and it sat underneath that Fibonacci line into the retracement back down to what we could see as 1,833 gold. So we have a little bit of weakness lately, but that's normal after a big move. And to sum this in plain English, it's just following essentially what traders would follow in terms of expectations for a market. We had a big move up. It's going to pull back a little bit. It's going to consolidate here. We see a lot of consolidation in this pattern, and it's staying within expected ranges. So we're not seeing a big crash in the gold price, which is why I'm not worried about it coming down substantially. I'm more thinking if we go back to the other chart that we're going to come back up and retest this upper green line and maybe punch through. And when we punch through is probably and stay through it this time, you know, it's where we're going to have that big move into the final leg of the bull. And that's confirmed by this 1900 price level here in the middle where we tested it in 2011, but it didn't go through the big channel. And now we're testing that channel again, but it hasn't gone through. So we haven't had the big breakouts, basically following CPI inflation. And you can see that the traders, if we go back to the shorter term chart, they're just trading within the ranges. This is all predictable trading that the systems are going to do, the pre-programmed trades, or the traders are going to look at. They're going to look at trading lines, Fibonacci lines, retracement lines, and they're going to trade to that. So I'm not really worried about the gold market being really soft. I think this is basic trading dynamics after a big bull move. There's a consolidation period, and at some point we're going to break out to the upside. Whether that's this year or not depends upon the news. Certainly people that look at like Elliott wave analysis and longer term technical charting can probably give us some targets as when they think that would happen. But right now I'm just mirroring the short term charts with what's going on fundamentally. I think the gold price is, you know, fairly priced right now, given what we're seeing, and we're not seeing the hidden stuff beneath the surface. We're not seeing the weakness in the labor market that's not being edified by the financial media. We're not seeing the banking system issues. I think people are aware of it, and that's why gold is in an uptrend, but we're not recognizing it. The markets we would have much, much higher gold prices. It may run to 2,800 to 3,000, even beyond that when we get into the real crisis. So what you're seeing on the chart essentially is awareness of what's going on, which puts it at the top of this range. But we haven't had the breakout where people are saying we're going full into gold and we're rotating out of other assets, I guess is the best way to put it. Now, just to see what is going on the Commitment of Traders report, for those of you who may be new to this, we get a report from the CFTC, which is the government regulator, on where the major participants is broken up into 4 or 5 major groups are participating. Are they on the long side or are they on the short side? And we look at this report because it explains to us whether the trend is up or down and who's participating in that trend. Who's putting, you know, the long side paper up because they think the price should go up. Who's putting the short side paper down because they think the price should go down. Now, when we look at the producer merchant category over here, whenever I look at that typically as legitimate hedging. Certainly producers and merchants can speculate and gamble on the market, but for the most part, they're protecting their interest in the market. If you're a producer, you're protecting against lower prices because you're producing gold or silver, and therefore you're going to want to take short positions. Why is that? It may seem counterintuitive. Well, if the price goes down, let's say gold, in this case, we're looking at silver. So if silver goes down from, you know, $29 to $27, that's a loss on the books of the mining companies producing it, because while they were digging out of the ground, they were expecting $29 for their estimates of what the revenue could be. So between the time that they're pulling out of the ground, getting it refined, getting it to market, they may want to take a short position, which if price falls, they'll make money on those short positions, which may offset their loss from actually taking the silver to market. On the long side, you'll see merchants who are going to buy it do upside price protection. So if they're building in $29 silver and it goes to 35, they may take a long position to hedge against that risk. So if it does go to 35, wow, they got to pay 35 an ounce now. That raises their costs a lot, you know, but at the same time, and that would be about 1/6 or about 15, 16% in that particular example. So they're going to take a long position on the market. And what that allows them to do is if the price goes up, they collect that money on the long side of the market by selling off those positions, and that offsets the higher prices they had to pay for the actual physical commodity. So that's usually legitimate trading. The swap dealers, also known as the bullion banks, can also participate in legitimate hedge trading for their clients, although given that a lot of the current production in silver and gold and these metals is covered by producer merchants, I think most of this is speculative, and it's because these positions change a lot and they tend to go against the market. So if silver or gold are rising, what you'll see the swap dealers do is come in and put a lot of short paper on the market. When they're reducing short paper, the market tends to rise. So they tend to trade opposite the market. And what they're doing is they're trading, positioning the market from the other players. And also, I think, gambling and speculating on the market. So interesting to note that they had, if you look at their short and long here for the swap dealers, this is swap dealers for silver. And we're looking at through April 30th because this data comes out after the fact. So it's about a week old. They added a few more silver positions, about 300 more than they did short, but net, it didn't change in the last weeks. In other words, that's where you're seeing a little bit of calmness in the silver price, is because there hasn't been big moves, especially on the bullion banks in terms of their positioning. Why does this matter? Because the bullion banks have the highest concentration of short positions on the market. The top 4 traders have almost a third of all the short positions in silver. And certainly you can see that here, they have 64,000 more than any other single group, even the ones that are legitimately hedging the downside risk, the miners. So the bullion banks take a bigger position on the short side than even the legitimate hedgers. And so a lot of this is continues to be considered speculative positioning to make money on the trade. Now, they're now more than 2 to 1 short, which basically means that they've got 2 times as much short paper as long paper. So they're now affecting a short position in the market. They're now pushing the market short with all that paper they pushed in. Just not long ago, within about 30 or so days, you saw the swap dealers or the bullion banks, even in their silver positioning, was about 29 to 30,000 contracts on either side. They've almost doubled their short position and only reduced their longs by a bit. So now they're more than 2 to 1 leverage to the short side. So they only make money when it goes down. So they're going to keep pushing short paper in that market to make money on their positions. Overall, the managed money is still bullish and long on silver, which is normal for this market. It's been this way for a while. The managed money are the financial houses, funds, those types of guys. And then the other reportables are just like wealthy individuals, family offices and things. And they're majorly long as well. So most of the financial interest in the market, other than the banks, are long. The banks are decidedly short, and they're the ones essentially holding the price down and trading against the market. And they tend to lead the direction. So as silver came down, they were adding silver positions. That's why silver came down. A similar thing going on in gold, although this past week through April 30th in gold, you can see that the bullion banks did reduce their short positions more than long. So they took basically net increased their short position because they reduced more longs than shorts. And right now they're sitting at not quite a 4 to 1 ratio in gold, short to long. Now, again, if you're not producing the gold or actually using the gold in production, why do the bullion banks need to be that long and short when we have this category over here, producer merchants, where legitimate hedging can take place? I think that they're trading on behalf of other people. It could be other sovereigns. It could be their own positions. It could be other financial interests in the space that want to see gold go short, but they're definitely holding the bulk of those short positions. And you can see here, top 4 traders on the market short, 36% is held, and most of that is held by the swap dealers along with the producer merchants, but they control a big part of this market. And if you go to 8 top traders short, 51.8%. So no other position on the market has 51.8% either long or short. It's just the 8 short traders. So there's concentrated shorting going on both gold and silver. And it's usually the bullion banks along with some of the miners. The miners have legitimate reasons to do it. The bullion banks, it's a little bit more ambiguous as to whether they do. Yes, they could be trading for their financial interests in the market, but why such a big concentrated position when the mine output and the merchants that need to hedge their upside price risk or already have their own category? And I say it's because of speculation. It's also to move the price around, because definitely the bullion banks have been pushing the price of gold and silver down, which is why you see gold and silver coming down here on this chart and sitting in that range trade. These traders are doing technical trading according to the charts to make money. They know what the chart says. They know what the Fibonacci's and the resistance and support lines are going to be, and they're using this positioning to hit these points to make money in the market. So in other words, it's not fundamentally driven market. It's basically a market trading on short-term trading patterns. We will see next time you see gold go up, we'll see if it challenges this long-term trend. And that would mean that maybe we have a fundamental breakout, not just a trading range breakout, but a fundamental breakout where people are rotating from other industries into gold and silver. We haven't had that yet. I wanted to also talk about how the gold and silver market works from a regulatory perspective. For example, there's something called performance bond requirements. This is basically minimum requirements to get into a contract or margin or whatever you want to call it. So essentially, the exchanges will set the amount that you need to enter to get into a contract. Now, these are leverage contracts. So with the COMEX 100 gold futures that you're seeing here on the screen, let me make this a little bit bigger for you guys. What that you're seeing is you're taking one contract of 100-ounce gold. And to do that, the initial maintenance, and this initial change was back on April 4th. So we're going to see 3 changes to the metal requirements. This one was on April 4th, and this is from the CME group. I just pulled it off of their website. We go down here to the metals. They do this for all of the whenever they change things for any of the exchange traded product. There are over 1,000 of them. They'll put it in this report. But looking at the gold one, the COMEX 100 gold futures, back on April 4th, it started off as the maintenance to own a single contract was $8,800. They increased it to $9,400, meaning it was more expensive to get into a contract. So certainly, if you were wanting to put a long or short contract in, it cost you more money to put in and to hold that contract. Now, 100 ounces of gold, of course, costs more than $9,400. This is just maintenance. This is just to take the position. It's a leverage market. You're controlling supposedly 100 ounces of physical gold using a paper contract that's only funded by a small percentage of the actual needed to settle that contract. And so what it allows is it allows control of a lot of figurative or virtual gold ounces at a very cheap price. But when they increase those maintenance requirements, not as many people can afford to trade that market. What that does is it, in my wording, de-democratizes that market. It tends to feed into the concentrated positions. Because if you're holding 51.8, if there are 8 traders holding 51.8% of positions, definitely they have the money to add more positions or subtract more positions at will. If you're one of these smaller guys and you're just holding a few positions over here, you're more likely to be affected by the increase in margin requirements. You may have less money in order to put that in, so it may discourage your trade. Well, look at who's committed to the trade. The people with the largest amount of positions are mostly short in gold and mostly short in silver. And the other guys are mostly long, but these are the smaller guys, the guys that can less afford to pay those increased margin requirements. So whenever they increase margin requirements for a contract in gold or silver, it tends to play in the hand of the big guys. Well, where are the big guys? They're short. So in this case, it decreases the potential that you're going to get more longs coming into the market and bidding that price up. So in other words, when they increase margin to hold a contract, the base amount you need to hold that contract and control all these ounces with a little bit of money, they're really less affecting the big guys and more affecting the small guys. And so the concentrated position being in short means you're going to have more downside pressure. So you'll see typically when they increase maintenance or money needed to hold one of those contracts, it decreases the long interest and increases the short interest. And that's when prices start to come down. That's a long way of saying when they increase maintenance, it plays in the hand of the big guys who happen to be short. So you're going to see a decrease in prices. You're going to see pressure to the downside as less longs come in to bid that price up, because the longs are more independently, focused on their individual positions, where the bullion banks have these big concentrated positions, and so do the mining companies and the merchants. So we go down to silver futures. It was increased from 8,500 to 9,500. That was on April 4th. You can see in the metals, both gold and silver, they increased the maintenance on April 4th, which tended to discourage the long side and encourage the short side just by the positioning we saw in the market. Now we're going to go to the next time that this happened. This happened on April 18th. This was 2 weeks later. They did it again. And you can see that, now they're doing aluminum, but this is the first aluminum. April 4th didn't have aluminum. It had other things like cattle and stuff. But you can see gold and silver is on this second one. They increased it from 9,400 to 10,000. So within the span of about 2.5 weeks, they went from 8,000 to 10,000, substantially increasing the price of a new contract. And this has the effect, given the positioning in the market, of affecting the small guys more, which happen to be long. So it puts downward pressure on the market in terms of prices. Or you can see it as like a price limiter. when you increase the cost of each contract, less independent longs will come in, and that plays more to the downside concentrated positioning of the bullion banks. If we go down to silver, this was gold and also silver, and went from 9,500 to 10,500. So they increased the price of a contract by 1,000 in silver. That's April 18th. Well, oh, I've got a third one. Here's May 2nd. So 2 weeks after the second one, which was 2 weeks after the first one. So the span of a month, they did a third one. And let's go down. And I didn't see gold on this chart. I think that they had sufficiently raised what they felt like the margin requirements to get into a contract in gold were, but they did do silver. And this has the effect of reducing silver down. Now it's, some of the maintenance went from different lengths. So they really were getting very specific with the lengths of contracts. So if you're in 14 plus months, the maintenance increased from 1,200 to 1,500. So, and on the micro silver futures from 77 and actually reduced it a little on some of the tiny silver futures, but increased it a little bit on the bigger 5,000 futures contracts. So essentially what you have there is you have the COMEX increasing margin requirements of gold and silver to the point at which it almost forced gold and silver into that trading range that we see on this chart here. It forced it into this trading range between, the Fibonacci high, which was breached to the high at 2,400, and brought it back down into the expected trend of gold in a decreasing trend by raising those margin requirements. In plain English, when they raised the margin requirements, gold fell out of the breakout into its expected trading range and tended to reduce the visibility of gold in that breakout that we had between April and the beginning of May. And you can see the alignment of those margin increases on the contracts aligning with the downside pressure on the chart in the gold price here. And it also happened to coincide with the silver price. So in other words, translate it, when they increase margin requirements on gold and silver, it tends to bring the price down. Why did they do it? Why did they increase the margin requirements? Well, only the CME group knows that, but they did, and it had an effect on price. And every time that we see them increase the margin requirements on these metals, it has a downward effect on price, not an upward effect on price, but a downward effect on price, because the concentrated positions are to the downside, not the upside. And so it discourages those smaller traders from being able to finance getting into a contract more than it does the bigger traders, because they already have the money and already have the concentrated position. So hopefully that kind of explains how the exchange and the regulator can do things that will affect the overall markets and bring it back into established trading ranges by changing how much money you have to get into one of these paper derivative contracts in the first place. And the bigger point to be made is none of this has bupkis to do with the physical trade. It just has to do with the spot price, which is determined by paper trading, not physical trading on this market. Last thing that I wanted to talk about was amendments to futures contract in connection with chain of custody. So this came out on February 27th. This is another one of the notices. I didn't see a lot of people reporting on this, but I thought it was somewhat interesting, so I want to talk about it. So it says here, quote, effective March 13th and pending all relevant Commodity Futures Trading Commission review periods, the COMEX will amend this rule on gold futures. And essentially what they're doing is they're adopting this new rule of the physically delivered gold contracts. And to summarize it, they're basically saying before you had to be an approved exchange, a depository, in order for the COMEX to take in that gold. And now what they've said is, well, you can be, you don't even have to be an approved COMEX depository. You can be a depository held by an approved COMEX depository participant. So in other words, let's say it's a Brinks, and Brinks has so many approved depositories, but they have other depositories. What the COMEX has just done is said, well, even though we're previously only using the gold stored in your COMEX approved depositories, Brinks, if you have other depositories, we'll consider that as well. What does that do? Well, it brings on more gold and silver that previously wasn't considered to be eligible into the eligible category, which is going to make it look like there's more gold and silver in the market. And that's great. If we have more gold and silver to trade in the market, that's a good thing. But this is just for eligible. And remember what the eligible category means. The eligible category essentially means this is not gold that we know that could be traded right now. It has to be from eligible to registered. When you get into registered, that's liquid gold or silver on the exchange. That's the one that's free to be put up for contracts in the current contract month if we want deliveries. The eligible is private storage, and we don't know in the mission of the CME group and the CFTC what a couple of years ago was, we don't know how much of that could actually be brought onto market. So I think what they're trying to do is to increase the potential liquidity of gold and silver on the market by including these other specific depositories that may not be currently exchange approved, but are run by companies that are exchange approved. So they're allowing them to go ahead and circumvent that approval process and go ahead and make that eligible. It potentially increases the liquidity in the system of gold and silver, which could be good, but it could be false liquidity because we don't know how much of that is actually going to be free to trade and exchange. So we'll have to see how that affects free gold and silver in the system for physical delivery. I anticipate this is done because there have been probably some behind the scenes delivery challenges with meeting all the contracts standing long for delivery, even though we didn't get that emission with that release. But what it does is increases liquidity. Right about the same time this year, a couple months before they started increasing the margin requirements, both have the effect of creating this sense that there's more gold and silver available, and then if you want to trade, it's going to cost you more, so it discourages. So what that does, I think, is create the illusion that there's more gold and silver available, which there may or may not be, and it decreases upside pressure to those markets because they made it more expensive to hold the position. So they're addressing both the potential physical shortfalls that may have been experiencing, while also decreasing the amount of longs that are going to stand for physical delivery by increasing the cost of getting into a long contract, and that plays into the hands of the shorts. And certainly we see those moves have an effect of reducing the upside pressure in the gold market and bringing that down. Similar thing in silver. We'll talk about that next week as we go into silver specifically. But I think those are some of the reasons you can see the behind the scenes kind of stuff that takes place in the market that can tend to move the price and can tend to affect the price. And certainly if you're a big bank and you have all these shorts on the market, you want the price to come down so your shorts are in the money. So if gold goes up too fast, it may be in your best interest, if you're one of the big players on the market, like the bullion banks or like these, these big hedgers, to have that price come down a little bit to get that money on the short side. But what it does is it discourages gold moving in a free market sense in terms of its physical trade. And so that's where you see the disconnect between all the physical that's being demanded around the world. And certainly there is a lot of physical being demanded around the world. We had reports of China telling their citizens buy gold, it's safer than currency. We have India buying record amounts of silver. The central banks are still buying gold. So we definitely see from a physical standpoint, industry and banking wants more gold, especially, and also industry wants more silver. But they're discouraging the quick price increases by using these behind the scenes sort of systems to kind of range trade that gold and silver to make it more manageable for the traders so they can trade it. Why are they doing that? Because it's a paper derivative market. They're not caring about the physical at this point in time, and they're trying to bring other physical stores on to create that illusion of additional metal, even though that hasn't been moved from eligible to register to where we know it's actually available. So it hasn't increased the actual known liquidity. It's created the perception that there's increased liquidity. So it kind of, both moves tend to calm the market down a little bit with respect to potential shortages of the physical and with respect to how many people are going to bid that up in anticipation of standing for physical by taking a long contract. Because if you want to stand for physical, you got to take a long contract and take that gold from delivery from the shorts or on the downside. So really kind of complicated. Hopefully I boiled that down in a way that you guys can understand and that makes sense. So that's the economy in the last couple of weeks. Just a quick summary: cooling labor market, increasing wage price increases, payrolls don't look as good, jobless claims went up, bond rates are going up, signaling more risk in the economy. Cryptocurrencies, Bitcoin came down from its high of about, was it 73,000 to about 63,000 today. So and the stock markets came down. So Bitcoin is acting more like a security, more like a bond or a stock than it is really an inflation hedge or a store of value at the moment. You can see that in the markets. It's really tracing more what's going on in the bond and stocks than it is with the metals. The metals had gone up this year, but were cooled off a little bit by the exchange. And so that creates the, I think, illusion or perception that metals are staying in a trading range and they haven't broken out. And it's interesting, they did all that to keep it from breaking out because that's the net effect. Why would they do that? Well, you can figure that out for yourself. But that's kind of what had happened and way the markets are working. That explains it to you. All right, now for the special announcement. We've changed this from Gold, Silver, Pros to the Freedom Report. The reason is I want to talk more than economics. I feel as though when we're talking about freedom, you have to have sound money. Sound money creates sound markets, which definitely increases the chance for both economic, cultural, and political freedom. But with the corruption in the markets, you also have the corruption of the culture, the corruption of politics, the corruption of everything else. And now that we've, documented over the last 3 or 4 years of corruption in the money system, and even, the gold system, the real money system, the constitutional money system, I think it's time to talk about some of these other things. So we're expanding content. I'm already starting to book some guests that will come on and talk about some of this expanded content. But we're going to talk about culture and politics, not from a red versus blue perspective, I'm an independent, and really closest thing, if you want to put me in a box, is to say libertarian. I'm very conservative fiscally. I'm very open to what people want to do politically and culturally, as long as we're not stepping on each other's toes and taking each other's property or our rights. And I think that there's a lot of room for us all to exist within our own space and our own belief systems, and allow other people to do the same. And I really want to find common ground, and we can find common ground in the finance world, but we also need to find common ground elsewhere. I think that we need to own the culture, because our culture is being sort of upended, and in some ways it's not being done in a positive way. It's being done in a way that creates conflict. And so I want to address some of those trends, and I want to talk about it. And I want to start to align the channel and the content of the channel with the studies I've done over changes that occur to these dominant nation states over time. Certainly, we've talked about four turnings and conjugative waves and 80-year cycles. That research kind of smushed together. Neil Howe and conjugative kind of bookended that. We sort of have the great taking, I guess, and ownership, things that we have to talk about economically. But beyond that, we're talking about the 250-year nation state cycle, John Glubb's research, or John Glubb research they did in 1971, and how that affects, are we in this 250-year nation state cycle in the U.S. that all these other dominant nations throughout history have been involved in? I think we certainly are. And we're going to talk about that. We're going to talk about some cultural, pop cultural, political, but by political, I just mean political freedom, because this is the Freedom Report. So we're going to talk about political freedom. We're going to talk about cultural freedom, and just overall measure of the freedom that we have in society. Certainly you can measure it with the monetary system, but I think we measure it in different ways. Lots of data that we can talk about, but also talking about current events and what's going on. So I'm going to move the news portion of what I normally do in the weekly market report to later in the week, and we're going to break that news out, and I'm going to talk about how that news affects us culturally, politically, and economically. But we're going to kind of separate the two and expand our content that way. Again, like I said, I'm also going to have some guests. I'm trying to book some guests on now that are going to talk about some of these other things that we're seeing in society. Recently did a spot for TV, a TV show that I may be involved with coming up. I'll announce more certainly as that gets closer to fruition, talking about liberty from a broader than a monetary viewpoint, talking about it from a culture and political standpoint. And if that TV series does get picked up and gets out, I'll let you guys know when that comes out, so you can see me there. Other good news, we invested in a movie called The Money Game several years ago. That movie's out. It's been produced and cut and sound and all that stuff. Lighting has all been done. Recently, a few weeks ago, it won awards for Best Picture and Best, I believe, Screenplay, if I remember correctly, at the Boston International Film Festival. It's been very well received by critics and the public. And certainly we're hoping to get that movie, the team is hoping to get that movie distributed. We're working on that and getting it, out so where you guys can see it. It's a great film. It has a legendary composer. The team that actually shot the film was the same team that shot Coda, which won Academy Award for Best Picture a few years ago. So it has a great production team on it, has a great message. And so certainly as that movie gets closer to being distributed, we'll let you know how that's being distributed and where you can see it. And we're doing the TV show and the movie to get these out to facilitate education, because the biggest piece of this is education. You guys have come to my channel for years, a lot of you, and certainly we're all well-versed in what goes on in gold, silver, and economics and some of these other things, but a lot of the public isn't. So we have to expand the media and expand the outlets that we're using to get the truth out to people, so that people can discover the truth for themselves and decide, remove this shroud and this shroud and this veil of obfuscation, of lies in some case, of misdirection that we've had about what's going on in the country, and talk more about the truth. And we have to go across different types of media in order to do that. So we're certainly doing that. We've got the social media, and we're trying to expand out into others. So, as that stuff gets closer to distribution, we work all of that out. I'll let you guys know, and we'll announce that on the program. That's going to do it for today. May 7th. God, we're into May already. So quickly through the year. May 7th, 2024, for the Freedom Report, formerly Gold Silver Pros. Now, if you want to find us, we're primarily on YouTube and Twitter right now under Freedom Report or The Freedom Report. You can find us. If you're already subscribed, you're already there. If you're not subscribed, make sure and subscribe to it and bookmark the page, because sometimes you may get unsubscribed or you may not get notifications. We want you to get those. And we're going to be re-establishing the podcast here pretty soon. We're out on Spotify and Apple Podcasts and all those podcast sites, but we haven't had the time really to update that, but we'll get that updated for those of you that listen to the podcast as well. And that will be coming in the next couple of weeks. So we'll get out there in the podcast format. So stay tuned to our channel for more as we expand coverage from just gold and silver in finance and the economy to the bigger picture of freedom, libertarianism, the republic that we have, the Constitution, and all the concepts that apply there. Until next time, this is Rob Kientz with the Freedom Report. See you next time.